Florida didn't drift into crisis. It broke under costs that rose faster than people could adapt. Over the last 4 years, Florida's housing system unraveled in plain sight. Insurance premiums didn't edge up. They exploded. Property taxes didn't stabilize. They reset. Meanwhile, household incomes barely moved. In coastal cities, homeowners are now facing $15,000 annual insurance bills just to remain insured. Not upgrades, not luxury coverage, basic permission to stay in their home. This isn't a housing market failing at the sale price. It's a market collapsing under the cost of ownership. From the quiet hollowing out of Florida's insurer of last resort to reassessments that arrive without warning, the system stopped working long before prices reacted. You won't see this clearly on a chart. You see it city by city. These are the 10 Florida cities where ownership stopped being sustainable, starting with the place most people still believe is safe. Number 10, Jacksonville. Jacksonville stretches across Duval County in northeast Florida, its St. Johns River waterfront and endless suburban neighborhoods long marketed as Florida's affordable alternative. Far enough north to avoid the worst hurricane landfalls. Far enough inland to sidestep coastal flood zones. For years, Jacksonville looked insulated from the chaos hitting South Florida. It wasn't. The shift didn't arrive all at once. It crept in through property tax bills. For homeowners without mortgages, annual property taxes now average around $2,400, climbing closer to $2,600 for those with loans. Between 2019 and 2024, those bills surged nearly 60%, one of the fastest increases anywhere in the state. Reassessments erased decades of relative stability, even for longtime residents who once relied on Save Our Homes protections to keep increases modest. Affordability still looked better on paper. Jacksonville's housing-to-income ratio sits around 24.8%, lower than Tampa or Miami. But that number hides a growing problem. It assumes insurance costs remain manageable. They didn't. Insurance premiums in Duval County climbed sharply despite Jacksonville's inland reputation. Homeowners who paid $1,800 to $2,500 annually in 2020 now face renewal quotes between $3,500 and $5,000 or more, depending on construction age, roof type, and coverage limits. That increase rewrote household budgets. Costs that once sat quietly beside the mortgage, insurance, property taxes, HOA fees in many neighborhoods became dominant expenses. Fixed housing costs alone now consume 20 to 30% of household income before a single mortgage payment is made. During the pandemic, Jacksonville benefited from that math. Families fleeing Miami, Fort Lauderdale, and West Palm Beach arrived searching for relief. They found it, briefly. By 2024, the same conversations began happening again. Kitchen tables replaced Miami condos. Jacksonville living rooms replaced Broward suburbs. The question stayed the same. Can we afford insurance that rises 20 to 30% every year with no visible ceiling? When a city designed to be Florida's pressure valve starts feeling the squeeze, the problem isn't regional anymore. And Jacksonville is still one of the easier cases. As we move south and closer to the coast, the math only gets uglier. Our 9th city shows how even inland Florida metros discovered there was nowhere left to hide. Number 9, Orlando. Orlando sits in central Florida, its theme parks and endless suburbs powering the state's tourism economy. Millions of visitors arrive each year. Hotels stay full, restaurants stay busy, jobs remain plentiful. On paper, this should be one of Florida's safest housing markets. For working families, it isn't. The strain shows up first in taxes. In Orange County, median property tax bills hover around $2,700 annually, rising closer to $2,900 for homeowners with mortgages. Reassessments pushed those bills steadily higher as home values surged. What once felt predictable became a recurring shock. Affordability still looked intact. Briefly, housing costs in Orlando consume roughly 26 to 28% of household income for typical homeowners, a level that appears sustainable at a glance. That calculation collapses once insurance enters the picture. Families earning $70,000 to $75,000 a year discovered that insurance, property taxes, and HOA fees alone now consume 35 to 40% of gross income before a single mortgage payment is made. By any economic definition, that is severe cost burden. Location offered no refuge. Orlando homeowners assumed distance from the coast would shield them from the worst insurance increases. It didn't. Policies that cost around $2,200 in 2020 jumped to $4,500, $5,000 even $6,000 by 2025 for ordinary single-family homes. The reason isn't geography. Insurers no longer price Orlando as an isolated inland market. They price it as part of a statewide exposure zone, wind damage, flooding from intense rainfall, systemic loss risk when any major storm triggers claims across Florida. Distance stopped mattering. That reality created a bitter paradox. Orlando's economy thrives on tourism, yet the people who keep it running increasingly can't afford to live there. Teachers educating hospitality workers' children, nurses staffing emergency rooms after theme park accidents, restaurant managers feeding millions of visitors each year, stable jobs, steady paychecks, housing costs racing far ahead of both. What once looked like insulation now feels like delay. And if Orlando's inland pressure feels heavy, it still isn't the breaking point. For retirees along Florida's coasts, the math turns brutal far faster. Our 8th city shows how decades of careful planning unraveled once insurance entered the equation. Number 8, Sarasota. Sarasota's Gulf Coast beaches and cultural scene once defined the Florida retirement dream. For decades, families planned their futures around it. Modest pensions, Social Security, careful savings, and a paid-off home near the water. That plan assumed stability. Sarasota didn't lose value, it lost viability. The pressure begins with insurance. Standard single-family homes in Sarasota County now carry annual premiums between $5,500 and $8,000. Waterfront properties or older construction routinely push that figure into 5 digits. $10,000, $12,000, even $15,000 a year. Those costs don't exist in isolation. Property taxes average $3,500 to $4,000 annually. HOA fees in many retirement communities add $200 to $400 every month. Before utilities, maintenance, or healthcare are counted, fixed housing costs now consume 35 to 45% of typical retirement income. For many households, the math becomes unavoidable. A retired couple receiving a combined $3,800 per month in Social Security, roughly average for middle-class retirees, faces housing costs between $2,400 and $3,200 each month. After insurance, taxes, and HOA fees, just $600 to $1,400 remain for food, prescriptions, transportation, and medical care. That isn't budgeting pressure. It's structural failure. Working families at least have options. They can add hours, change jobs, or relocate for income growth. Retirees can't. Social Security adjustments creep upward at 2 to 3% a year, while housing costs surged 40 to 60% in just a few years. The gap widens annually and never closes. Plans built on $1,500 a month for housing in 2020 now require $2,400 to $2,800 in 2025 and 2026. That shift doesn't invite belt tightening. It forces accelerated savings depletion that empties accounts a decade before life expectancy. The consequence is something Florida has never seen at scale: reverse migration. Retirees who sold homes in the Midwest to retire in Sarasota are now selling again, not to upgrade or downsize, but to escape costs they cannot out-earn or out-budget. Estate plans once centered on passing Sarasota homes to children now revolve around liquidation. The conversations aren't about legacy anymore. They're about survival, leaving friends, routines, and the life they spent 40 years preparing for. Sarasota didn't fail retirees emotionally. It failed them mathematically. And if this is happening in a refined retirement market, Southwest Florida shows what happens when insurance pressure collides with sudden tax spikes. Our 7th city reveals how local government costs turn crisis into collapse. Number 7, Fort Myers Beach. Fort Myers Beach sits on Estero Island, a narrow barrier island built around a simple promise: coastal living for people who actually lived there. Not hedge funds, not seasonal investors, families, tradespeople, small business owners, generations who treated the island as home, not an asset. Hurricane Ian didn't just tear through buildings. In September 2022, it reset the economics of staying. Reconstruction brought new roofs, reinforced foundations, and hardened infrastructure, but it also delivered bills few residents were prepared to carry long-term. What followed wasn't recovery. It was compounding pressure. The first shock came from local government. For the 2025 to 2026 fiscal year, the town of Fort Myers Beach approved roughly a 26% increase in its millage rate, rising from about 1.00 to 1.25 mils per $1,000 of assessed value. On a $400,000 home, that alone adds about $1,000 per year in town taxes. That increase sits on top of everything else. Lee County median property tax bills already run around $2,600 to $2,700 annually. Barrier Island properties add special assessments for beach renourishment, infrastructure hardening, and storm recovery. For many Fort Myers Beach homeowners, total annual property taxes now exceed $5,000 to $6,000 before insurance enters the picture. Then insurance arrives. Barrier Island exposure places Fort Myers Beach among Florida's highest risk zones. Standard homeowners policies now cost $8,000 to $12,000 annually. Older homes, elevated rebuild costs, or construction predating modern codes push premiums into the $15,000 to $20,000 range. Put the numbers together. A $400,000 Fort Myers Beach home now carries $15,000 to $18,000 per year in insurance and property taxes alone. No mortgage, no HOA fees, no utilities or maintenance. For households earning $60,000 to $70,000, typical for longtime residents, that absorbs 25% to 30% of gross income before basic living expenses begin. Surviving the hurricane didn't end the crisis. Rebuilding triggered it. Insurance companies refused renewals, forced homeowners into surplus markets, or imposed exclusions that left families partially exposed. At the same time, post-storm demand from affluent cash buyers pushed assessed values higher, resetting property taxes for residents who had relied on long-standing caps. The result is quiet displacement. Families whose parents and grandparents lived on Estero Island are selling, not to move up, not to cash out, but to escape a cost structure that no longer allows middle-class ownership. Heritage gave way to liquidity, roots were priced out by math. Fort Myers Beach shows how climate events don't have to erase homes to erase communities. The system finishes the job afterward. And if this is what happens on a rebuilt Barrier Island, the next city reveals something worse. Insurance pressure colliding with failing infrastructure. Cape Coral shows how affordability collapses without a single storm. Number 6, Cape Coral. Cape Coral was built on a promise Florida sold hard: waterfront living for working families. 400 miles of canals, private docks, Gulf access without beachfront prices, teachers, electricians, small business owners, people who could finally live on the water without millionaire incomes. That model didn't erode slowly. It collapsed when two systems failed at the same time. Insurance broke first. Median home prices in Cape Coral still sit around $385,000, nearly 80% above pre-pandemic levels. Canal homes carry layered risk: waterfront exposure, aging seawalls, flood classifications, and higher replacement costs. Insurers price every one of those factors aggressively. For many canal properties, combined homeowners and flood insurance now runs $7,000 to $10,000 annually. Older homes or higher value builds routinely see $12,000 to $15,000. These are no longer outliers. They are typical. Cape Coral's median household income falls between $60,000 and $65,000. Insurance alone now consumes 11% to 15% of gross income before property taxes, utilities, HOA fees, or a mortgage enter the equation. Then the second failure hit. Cape Coral's water treatment system was designed in the 1970s for a city of roughly 40,000 residents. Today, it serves more than 200,000. The system operates beyond capacity, faces federal compliance pressure, and requires urgent upgrades just to remain functional. Those repairs aren't optional, and they aren't free. Costs flow directly to homeowners through special assessments and utility rate increases. Water, sewer, and stormwater bills that once averaged around $150 per month now reach $250 to $300 in many neighborhoods, adding $1,200 to $1,800 annually in mandatory expenses layered on top of rising insurance. The city's defining feature became its undoing. Canals raise insurance premiums. Seawalls require maintenance that can cost $5,000 to $15,000 per homeowner. Water quality issues in certain canal systems raise long-term questions about value and future insurability. What once sold as an asset quietly became a liability families couldn't escape. Selling doesn't fix it. Buyers research insurance quotes. They calculate utility bills. They learn about seawall responsibility. Then they walk. Listings sit, prices fall, demand thins. Owners discover they're trapped in properties that bleed cash and attract few qualified buyers. Cape Coral marketed itself as attainable waterfront living. What emerged instead was a cost structure that devours middle-class income: insurance, utilities, property taxes, deferred infrastructure. Together, those expenses now consume 40% to 50% of household income for many families before a mortgage payment is made. The water didn't move, the math did. And if Cape Coral shows how working families lost the waterfront dream, the next city reveals something more unsettling: markets where even wealth couldn't outrun insurance collapse. Our fifth city proves money stopped being a shield. Number 5, West Palm Beach. West Palm Beach built its reputation as the attainable side of South Florida luxury, close enough to Palm Beach to share the coastal appeal, far enough to avoid billionaire price tags. Upper-middle-class professionals moved in expecting comfort, stability, and long-term affordability. That expectation didn't survive the insurance cycle. The pressure appears before the mortgage. Average homeowners insurance across Palm Beach County sits around $5,200 annually, but West Palm Beach homeowners pay materially more. By 2026, typical premiums reached roughly $8,600 per year and continued climbing. Income wasn't the problem. Household earnings in West Palm Beach commonly range between $85,000 and $95,000, with many families earning well above that. Even so, $8,600 in insurance alone consumes nearly 10% of gross income before property taxes. HOA fees, or mortgage payments, enter the equation. Add the rest, and the math tightens quickly. Property taxes average $4,000 to $5,000 annually. HOA fees are common. Combined fixed housing costs, insurance, taxes, association fees now absorb 25 to 35% of gross income for typical homeowners before a single mortgage payment is made. That sits at the outer edge of what lending standards consider sustainable. This is where West Palm Beach becomes revealing. These aren't households struggling to get by. These are professionals with savings, equity, and options. When people with six-figure incomes begin questioning whether staying makes sense, the issue isn't affordability at the margins. It's structural failure. The conversations are no longer private. Professional forums and neighborhood groups repeat the same refrain. We earn $200,000 combined and can't justify this anymore. Insurance hit $18,000. We're done. We paid off the mortgage and still spend more every month than we did before. That marks a break from Florida's historical pattern. Wealth is leaving, not because opportunity disappeared, but because the economics of ownership stopped working. These households aren't trapped, they're mobile, and they're choosing to exit. That departure doesn't stay contained. Companies drawn to Florida for tax advantages now struggle to recruit. Candidates research housing costs, insurance requirements, and climate exposure before accepting offers. Some negotiate housing stipends, others decline outright. When fixed housing costs erase the benefit of no state income tax, relocation loses its appeal. West Palm Beach employers report offers falling through for reasons unrelated to salary or job quality. Insurance math does the rejecting. This is why the city matters. Florida's crisis isn't limited to lower-income households being priced out. That's painful, but familiar. West Palm Beach shows something rarer. Households in the top income brackets discovering that insurance costs rise faster than any realistic income growth. When wealth stops acting as a buffer, the problem isn't cyclical. It's systemic. And if West Palm Beach couldn't outrun the insurance collapse, the next city shows what happens where premiums surge even higher. Fort Lauderdale marks the epicenter of Florida's insurance cost explosion. Number 4. Fort Lauderdale. Fort Lauderdale's beaches, intracoastal waterway, and dense urban core once made it South Florida's pressure valve. Not Miami's price tag, not Miami's congestion, coastal living that still felt attainable. That distinction collapsed when insurance stopped functioning. What residents face now isn't simply higher premiums. It's a market that barely exists. Across Broward County, average homeowners insurance sits around $5,100 annually. Inside Fort Lauderdale, the numbers detach from reality. By 2026, typical premiums reached roughly $10,900 per year for standard coverage. That figure isn't a worst case. It isn't beachfront only. It's the citywide average. Median household income for Fort Lauderdale homeowners runs between $70,000 and $75,000. An insurance bill approaching $11,000 consumes 14 to 15% of gross income before property taxes, HOA fees, or any other housing cost is paid. One expense now rivals entire household categories. Insurance alone absorbs what many families once spent on food, transportation, or healthcare combined. A single bill crowds out basic living. Cost, however, isn't the deepest failure. Availability is. Major insurers no longer write new policies across much of Fort Lauderdale. Others refuse renewals, pushing homeowners into the surplus lines market. Smaller, lightly capitalized carriers offering coverage with higher deductibles, narrower terms, and rapidly escalating premiums. Buyers no longer negotiate price. They hunt for coverage. 3 or 4 quotes return, all above $8,000, or none arrive at all. Transactions collapse when lenders require insurance. Buyers cannot secure at any price that passes debt-to-income rules. Listings sit, reductions stack, qualified buyers vanish. The condo market absorbs the hardest blow. Building-level insurance for Fort Lauderdale's high-rises has tripled or quadrupled in many associations. Those increases pass straight to unit owners through surging HOA fees and special assessments. Individual unit insurance layers on top. Owners now face $10,000 a year in personal coverage. HOA dues that jumped from $300 monthly to $600 or $800, plus additional assessments mandated by post-Surfside reserve laws. Before a mortgage payment is made, total annual housing costs for many condos exceed $20,000 to $25,000. That math breaks ownership. Condos once marketed as affordable coastal alternatives now trap owners in place. Selling fails when buyers walk after insurance quotes. Staying fails as carrying costs drain savings faster than appreciation can replace it. Equity turns illiquid. Homes purchased for $300,000 to $400,000 may still appraise higher, but value no longer matters when exit routes disappear. Walking away destroys credit. Staying accelerates loss. Selling at a rational price becomes impossible. Fort Lauderdale shows what happens when insurance doesn't just get expensive. It blocks transactions entirely. And if $10,000 premiums feel extreme, the next city proves even that wasn't the ceiling. Naples reveals how luxury markets collapsed once insurance reached its final form. Number 3, Naples. Naples and Marco Island sold certainty. Pristine Gulf beaches, championship golf, private clubs, cultural institutions, a promise that premium living meant insulation from volatility. Affluent retirees moved here believing money solved problems. Insurance proved it doesn't. Collier County's reported average premiums hover around $4,200 annually, but those numbers are meaningless inside Naples' actual market. Replacement values are higher. Construction skews older. Coastal exposure is unavoidable. Real premiums live far above county averages. For homes valued between $800,000 and $1.2 million, ordinary by Naples standards, annual insurance now runs $12,000 to $18,000. Beachfront and Gulf access properties push past $20,000. In some cases, well past. These are no longer edge cases. They define the market. Property taxes on an $800,000 home approach $8,000 annually. HOA fees in luxury communities commonly range from $400 to $700 per month. Before a mortgage payment is made, fixed housing costs reach $35,000 to $45,000 a year. That's where the illusion breaks. Naples homeowners are not financially fragile. Many retirees here draw $120,000 to $200,000 annually from Social Security, pensions, and investment income. That places them comfortably in the top tier of American retirees. Even at those levels, fixed housing costs absorb 18% to 37% of gross income before debt service. And unlike working households, income is capped. Investment portfolios designed for 5% to 6% annual returns cannot outrun insurance premiums rising 20% to 30% per year. Social Security adjustments grow 2% to 3%. The math diverges permanently. What once looked conservative now looks reckless. Naples' real estate market reflects the shift. Listings that once cleared in weeks now linger for months. $1.2 million homes sit for 90 to 120 days, reduced to 1.1, then under $1 million, still waiting. Buyers aren't failing to qualify. They're walking away. Insurance quotes land at $15,000 to $20,000 annually, paired with warnings of continued escalation. Sophisticated buyers recognize the trajectory immediately. Wealth building turns into wealth erosion. Luxury agents hear the same conclusion over and over. We can afford this. We just don't want it. Naples reveals something more dangerous than affordability loss. It reveals capital flight. High net worth households don't get trapped. They exit early. For those who stayed, the erosion is already visible. A homeowner who bought for $900,000 3 years ago might see a paper value of $1 million today, but excess insurance, rising taxes, and HOA increases quietly consumed that gain. $35,000 to $45,000 in unplanned insurance costs, $8,000 to $10,000 in tax increases, another $12,000 in association fees. Appreciation disappears. Real returns turn negative. This isn't a middle-class story. It's a luxury market discovering that fixed costs can destroy wealth faster than appreciation can rebuild it. And if Naples represents the top of Florida's market failing under insurance pressure, the next city shows what happens when the crisis hits at metropolitan scale. Tampa reveals how population density multiplies the damage. Number 2, Tampa. Tampa Bay shouldn't be fragile. More than 3 million people live across Hillsborough and Pinellas counties. Finance, healthcare, logistics, defense, tourism, downtown Tampa's medical and financial hubs, Brandon and Valrico's family suburbs, St. Petersburg's waterfront neighborhoods, Clearwater's beaches. This is the kind of metro that normally absorbs shocks. It didn't. Tampa became the place where Florida's insurance crisis collided with runaway property taxes, and the combination broke the math at scale. Property taxes moved first. Across the metro, tax bills climbed more than 56% between 2019 and 2024. That pace ranks among the fastest increases in Florida and one of the sharpest accelerations of any major U.S. city. The jump wasn't gradual, it was sudden. Families who planned around $3,000 a year in property taxes before the pandemic now face $5,000 to $6,000 by 2026. Buyers who entered the market after 2020 saw reassessments reset immediately, bypassing decades of Save Our Homes protections. Velocity became the crisis. Hillsborough County's median tax bill for mortgaged homeowners sits just over $3,100, but that number hides what residents actually experienced: the speed of change. Tampa didn't drift upward, it surged. Insurance arrived next. Across Tampa Bay, typical single-family homeowners now pay between $5,500 and $7,500 annually. Older construction, proximity to water, or higher replacement values push premiums into the $8,000 to $12,000 range. Layer the costs together: property taxes, insurance, HOA fees common in suburban communities. Fixed housing costs now total $11,000 to $15,000 per year before a mortgage payment is made. Median homeowner household income in Tampa runs roughly $80,000 to $85,000. Those fixed costs alone consume 13% to 18% of gross income. Then the mortgage hits. On a median $410,000 home, recent interest rates push payments toward $2,500 a month. Annual housing costs climb to $40,000 to $43,000. That's nearly half of gross income for a typical Tampa homeowner household. Official affordability metrics understate the damage. National cost burden studies often lag real conditions, missing insurance repricing and tax resets that hit between reporting cycles. Families living it describe a different reality. 35% to 45% of income consumed once insurance, taxes, utilities, maintenance, and debt are fully counted. At that level, resilience disappears. What makes Tampa different isn't severity, it's scale. This isn't a resort town or a luxury enclave. It's a major American metro. When cost pressure hits 3 million people at once, consequences cascade. Families leave for Georgia, Tennessee, and the Carolinas. Employers struggle to recruit, schools lose enrollment, hospitals lose nurses and support staff who can't afford housing near work. Infrastructure maintenance falls behind as tax bases thin and demands rise. The system feeds on itself. As higher-income residents exit, municipalities face impossible choices: raise rates on those who remain or cut services that make the metro functional. Either option accelerates departure incentives. That's the warning Tampa delivers. Major metros aren't supposed to fail affordability tests this quickly. They usually bend, then adapt. But Tampa didn't. When a diversified 3 million person economy can't absorb insurance and tax acceleration, the problem isn't localized stress, it's structural breakdown. And if Tampa shows what happens when the crisis hits at metropolitan scale, the next city reveals the endpoint, where insurance, affordability, and liquidity all collapse at once. Miami isn't just worse, it's final. Number 1. Miami. Miami didn't drift into crisis, it collided with it. Across Miami-Dade County, housing costs crossed a threshold no major American city has ever sustained. Not gradually, not cyclically, completely. Among large U.S. metros, Miami now carries the highest housing cost burden in America. Median homeowner housing costs run about $2,125 per month, while median household income sits near $66,000. That produces a housing-to-income ratio of 36%, the worst of any major U.S. city measured. 30% defines cost-burdened. Miami exceeds it by a wide margin. This isn't a fringe problem or a low-income crisis. These are typical homeowners spending more than 1/3 of gross income on housing before food, transportation, healthcare, or childcare enter the equation. Insurance is the accelerant. State data lists Miami-Dade average homeowners insurance around $5,400 annually. But that number no longer reflects reality. Coastal exposure, aging construction, dense condo development, and rising replacement costs push real premiums far higher. By 2026, many Miami homeowners face insurance quotes between $8,000 and $12,000 per year for standard homes. Waterfront and higher value properties routinely see $15,000 to $20,000 or more. These figures are no longer exceptional. They are common. Property taxes compound the pressure. Miami-Dade median tax bills hover around $3,500 to $3,800 annually. HOA fees apply to a large share of the market. Before a single mortgage payment is made, fixed housing costs often exceed $15,000 to $20,000 per year. Price is no longer the constraint. Insurance is. That distinction matters because once insurance becomes the bottleneck, housing markets stop functioning. Sellers can cut prices. Buyers can qualify for mortgages. None of it matters if coverage is unavailable or destroys debt-to-income ratios. Miami's listings show the result. Homes sit longer. Price cuts stack. Deals collapse during underwriting when insurance quotes arrive. Dropping a home from $700,000 to $650,000 doesn't solve a $15,000 insurance bill. Cutting another $50,000 doesn't either. Markets cannot clear when insurance, not price, sets the ceiling. Nowhere is this clearer than in Miami's condo market. Master insurance policies tripled or quadrupled. Reserve funding mandates exposed years of deferred maintenance. Special assessments followed. Condo owners now face stacked costs few anticipated: $10,000 to $15,000 in individual insurance, HOA fees doubling or tripling, assessments running into the tens of thousands, and property taxes on top. All while values stagnate as buyers recognize the cost structure is permanent. Owners are trapped. Staying drains savings. Selling erases equity. Walking away destroys credit. This is not a normal housing downturn. It is an equity lock. Miami once defined Florida's rise. Domestic migration, international inflows, corporate relocations, and industry expansion fueled the boom. That engine stalled. Net domestic migration fell as insurance and affordability overwhelmed the benefits of no state income tax and coastal living. Saving $10,000 in taxes means little when housing costs rise $20,000 to $30,000. Employers feel it. Candidates decline offers, executives demand housing allowances, skilled workers leave for places where the math still works. Miami's breakdown matters because it isn't local, it's structural. When insurance fails faster than incomes can adjust and faster than prices can correct, housing becomes uninsurable before it becomes unaffordable. And once that happens, markets don't recover gradually. They seize. Miami didn't approach the edge. It went over. And once insurance breaks a housing market, there is only one outcome: exit. In conclusion, taken together, these 10 Florida cities reveal something far more serious than a housing downturn. They show a system breaking in real time. From Jacksonville's fading affordability to Miami's market paralysis, the pattern is consistent and unmistakable. Insurance costs exploded at triple-digit rates. Property taxes accelerated 40% to 60% in just a few years. Household incomes grew barely 8% to 10% over the same period. That divergence didn't merely strain the housing system, it destroyed the math that once made middle-class homeownership possible. Florida didn't experience a correction. It crossed a threshold. From a legal perspective, the implications are unprecedented. Florida law requires homeowners with outstanding mortgages to carry insurance. That mandate is absolute, yet insurers increasingly refuse coverage or price it far beyond what median-income households can afford. Legal title remains intact. Deeds still exist. Ownership survives on paper. In practice, 2 of the 3 core property rights have eroded. The right to occupy fails when mandatory insurance consumes an unsustainable share of income. The right to transfer fails when buyers cannot obtain lender-acceptable coverage at any price. When property cannot be used or sold, the distinction between legal ownership and functional ownership collapses. That collision forces property law into territory it has never fully confronted. The Fifth Amendment prohibits taking without just compensation, yet Florida's crisis exposes a gray zone where property is not seized, but rendered economically unusable through regulatory mandates colliding with market failure. Economically, the warning signs are unmistakable. Florida now exhibits classic markers of structural failure. Housing supply exists, yet transactions stall because insurance blocks completion. Cost-to-income balance shattered as expenses rose 150% to 200%, while wages stagnated. Liquidity evaporated not from mispricing, but from transaction impossibility. This is not cyclical stress. This is system malfunction. The 10 cities you've seen represent millions of households facing impossible choices: stay and drain savings, sell and lose equity, or walk away and destroy credit. That is not how homeownership functions in a stable economy. Florida didn't stumble into this moment. It revealed it. What failed here will not stay contained. Similar pressures are already forming across the Gulf Coast and other high-risk states where insurance is tightening faster than incomes can adapt. Climate risk didn't create the crisis. Insurance pricing made it unavoidable. Florida is the case study. It shows what happens when insurance becomes the gatekeeper of housing rather than its safeguard. When that gate closes, markets don't slowly decline. They seize. This isn't speculation, it's observation. Florida showed us the failure first. Now it's spreading. Subscribe to Uncover the Cities for forensic analysis that follows the data, not the headlines.